if you think about the markets, it's supply and demand driven, right? So what we're watching, one of the things that we're concerned about is if the money's flowing in, buyers in control, demand's in control, and is pushing prices higher.
Mhm.
If money is flowing out, the money's flowing away, supply is in control, prices are getting pushed lower. So we want to monitor that and see what's actually happening.
Hello, everyone, and welcome to the big show. My name is Josh Lilquist, and we're happy to have you with us today. As always, I always bring special guests on the show. He was on about, 6-8 months ago.
Yep.
CMT Scott Maragioglio. How are you doing today, Scott?
Great. How you doing?
I'm doing really good. Last time we were talking about, I'm going to just dive right into the topic here.
Okay.
We were talking a lot about market breadth, right?
Yep.
And we were kind of going through, this was about 8 months ago, what that really is. Just recap real quick what that actually is. And I want to talk about kind of what happened back in when the coronavirus started and what you're seeing right now with the markets and what's happening with just the volatility as well.
Okay. So when we talk about market breadth, what we're talking about is it's an indicator that's commonly used by technicians to probably the easiest way to describe it is what we're really trying to do is a proxy for trying to figure out which way the money is flowing into the market. Is money flowing into the market or out of the market?
Now, when you say the money, is that like the big institutions, banks, or everybody in general?
It's everything, but the institutions and banks are the guys that control most of the money. So it's primarily them. But yeah, it's all the money.
Okay.
If you think about the markets, it's supply and demand driven, right? So what we're watching, one of the things that we're concerned about is if the money's flowing in, buyers in control, demand's in control, and is pushing prices higher.
Mhm.
If money is flowing out, the money's flowing away, supply is in control, prices are getting pushed lower. So we want to monitor that and see what's actually happening. And then we can get a little more sophisticated with it and use it to try to predict major turns in the market, bear markets, try to dissect or try to diagnose whether or not you're in a new bear market or if it's just a corrective phase. Those sorts of things. It's very useful for those sorts of tactics.
Sure.
We also extend that into something called breadth internals, which is another level for breadth indicators that we look at. So it gets more sophisticated, when you go into, but we'll probably just keep it at a simple level.
Sure. Now, back when the market took a little haircut back about a year ago now.
Yep.
Roughly 35% roughly. What did you see then with the market breadth?
Okay.
As far as where that was and what really happened with that big dump in the market?
So that's the coronavirus break that we had. So
Yep.
a 35% drop in the market. The what breadth was doing heading into that was breadth was actually making new highs. So when we see the market making new highs in price and it's confirmed by breadth, that means money's flowing in and it's been pushing prices higher. When we with that in mind, you can get a corrective phase, typically a 7, 10, 15% corrective phase that at any given time for any reason. But if breadth was confirming the highs along with the market, and then the market starts to break down, we can start to make some guesses that it's probably a corrective phase and not the end of a bear market.
Sure.
Or a start of a bear market, excuse me. So if we see, but now on the other hand, if we see breadth heading lower and moving lower, but price is still moving up in the indexes, that's a real good sign. It's called a breadth divergence. And that's a really good sign that you're close to a market top. The money's starting to flow away. The price is still going higher. And you're seeing the money that's left get concentrated on fewer and fewer names, and they kind of spur it up. That's what keeps the prices going up. And that's a setup for a bear market. So when you see that, you need to be really concerned. It usually happens before you see that diversion before the bear market happens. It's a setup, and then boom. 2000 would be a really great example of that. And I think every market top going back, except 2008 and 1953 were the two times you didn't really get a big divergence. But every other time in the market, you've had a divergence.
Really?
Yeah. So what I saw when the coronavirus thing hit, breadth was hitting the highs. The coronavirus crisis hit. You saw market now that's an unknown. So prices really had a strong reaction to it because, who knows how bad this is, right?
Yeah.
But the setup suggested to me that you'd have the corrective action, the corrective phase, and then you would have a fairly speedy recovery because it was more indicative of a correction. It was a big one than it was a bear market or a bear market top.
Yeah.
So some people just say, "Oh, it's down 20%. It's a bear market." That's I don't really look at it that way. I look at it as you know, was there a structural change that's going to lead to something like a 2008 bear market? And wasn't quite the case. So that suggested you're going to have a really rapid or fairly rapid recovery, which
Yeah.
we saw,
And
and
that
it
it
took off.
was.
Yeah, it went all the way back and took off as soon as the unknown went from an unknown to a known. They were comfortable getting back in, and obviously with all the money that was printed and all the stimulus, it just
Yeah.
came roaring back.
And it's still coming,
And it's
all the
still,
stimulus. I mean, who knows how much more they're going to continue to print and more stimulus money for people, the public.
yeah,
It's crazy. No, with kind of, the markets have this past week again, I believe, hit all-time highs again.
yeah.
Now, are you seeing that inflow of money in the market breadth? Is that still there?
Yeah, yeah. We had some signs, and this is really bullish. I had some signs that there could be some corrective action in the works. This is going back a couple weeks ago, last month, and a
Hmm.
couple weeks ago. It looked like there was some divergences internally, that momentum divergences with breadth internals that might suggest that the market might be heading to a corrective phase, and then it just overrode it. Just completely overrode that. So you see things like that. When you see setups that don't pan out,
Hmm.
that's typically really, really bullish. Now they had passed a stimulus bill, and it just overrode that kind of negative internal momentum in the
Yeah.
market, and breadth made another new high.
Yep.
So we just keep getting confirmation that there's just a lot of money
Hmm.
in the market, and if there's a lot of money in the market, it will find a way to go higher. Typically,
Yeah. Well, all these stimulus, I mean, they're saying, they are saying everybody that gets one is going to be putting it into the market. That's kind of what the talk is, right?
yeah, it's just a lot of money floating around.
Yeah.
Is what it comes down to.
But here, I got a question for you. So there's the old saying from by Warren Buffett: "Be fearful when others are greedy. Be greedy when others are fearful." Right.
Yep.
Now we are at all time highs right now. The breadth is, in your case, you use that as an indicator or as maybe an odds enhancer. It's not a
Mhm.
be right every time, but if you put the odds in your favor, you're just adding those probabilities, right?
Yes.
With all the great things that are happening, obviously there's a recovery happening from the coronavirus. It's a little slower than I guess economically we expected, but there's a lot of happiness in the market. There's new political office. There's stimulus. There's things are looking great with the vaccines
Yeah,
and
like
everything.
everybody's so bullish that
Yeah,
is it actually bearish,
yeah.
right?
Well, that's kind of the opposite, right?
Yeah. Well, look, I mean, when this market ultimately tops and rolls over, it's not going to, the all the markers are there.
Hmm.
Like all the excess speculation, all the things you'd look for at the top of a bull market are there. They're present right now.
Hmm.
Um, you know, so when it happens, we can say, "Oh, look, it was obvious, obviously,
Yeah.
right?" So it's all there. But at the moment, breath is still making high, still looks good. What I think could change, and what I'm watching very closely is this reinflation. Now,
Mhm.
this reinflation idea is instead of people being worried about inflation coming back, what they're doing is they're saying, "Oh, well, that means the economy's coming back," and they're going and chasing cyclical stocks and driving those up, and they're just making it into a bullish theme. But if you look at the bond prices are falling. Rates are starting to come up. Now they're not up a lot, but if that continues, if bond prices keep falling, that's going to create. If we look at it from an intermarket situation, that's going to start creating, or it is creating pressure
Mhm.
on stocks. When it starts to pan out, we don't know, but rates are still really low. But if that continues, that will keep creating bearish pressure on stocks until finally stocks break.
Yep.
When that happens, I don't know. And that's why I would watch something like breadth. If I start to see a breadth divergence where stocks start to drift away or internally it loses the momentum, money starts to flow out, but prices are still holding up, that's going to be my signal that, now we need to be really
Yep.
cautious.
So you're looking at multiple things, even with like say the US dollar. I mean, if
Yeah.
they cut rates or whatever that may be, they raise and whatever it is, that's going to affect the stock market. If the US dollar is going to be
Absolutely.
is showing some strength,
Yep.
that could potentially drop the market as well. We don't know, but
Well, the way I would really look at it is from the intermarket relationship. So the dollar affects commodities, commodities affect commodities, represent inflation, commodities affect bonds, bonds affect stocks. So it's a
Hmm.
circular relationship. So what we've seen is we've had some overall some decent dollar weakness in the little longer term picture. That's if you look at commodity prices are shooting straight
Yeah,
up. Crude
oil's been going up.
oil's been going up real strong. I'm not sure how much further that's going to go, but I'm watching it.
It's
Oil,
been slowing down the past week or so.
right? We've gotten copper that's really run, which is a pretty good indication of economic recovery
Hmm.
and possible inflation. So there's been a lot. If you look at the commodities market, it's been shooting straight up.
Yep.
That rise in commodity prices, which is inflationary in nature, has been now has shown up in bond prices. And that's where the bearish pressure comes in bonds. Now you're starting to see bonds start to roll over a little bit. If now there's like a lag time here. If the pressure in bonds keeps coming and bonds keep falling and rates
Hmm.
start rising slowly, that's going to create more and more bearish pressure on stocks, which eventually will break it.
Yep.
So there's like a lag time between these relationships, and they start to spill over into one another,
Yeah.
and it goes in a circular kind of pattern.
Yeah.
So that's what I'm watching right now. That's what I'm concerned about. But at the moment, internally, it doesn't look like it's ready to break. But that's what I'm watching.
Yep. But there's several things there,
Yeah.
several indicators that
Yeah.
potential. But that's why it's important to have, investment strategy where you have not just one indicator, not just one thing you're looking at, because there's multiple things that could create a bullish market or a bearish market. But just following a plan too, right? I'm sure you have a strict set of rules within those things you're looking at, right?
Yeah, absolutely. So we structure our trading. Obviously, you have to control risk. And not participating when it's going the right direction. It's also like being out of it. So all of this is like, can I stay in? How long can I stay in? When do the risks of staying in exceed, maybe I should just get out.
Mm-hmm.
All of this kind of fits together. So it's, there's a big difference between just doing analysis and trading. You have to learn the mechanical structure of trading, how to stay in your trades, when to get out of your trades, et cetera. So
Mm-hmm.
all this fits together.
Yep. You post a lot of stuff on Twitter about breath. Where can people find you? What's the Twitter handle?
My Twitter handle is SMARAGIO on Twitter, so you can find me there. And yeah, I post a lot of stuff about breath. Breath is pretty easy to track down. Just need, if you go to something like TradingView or anything else, they'll have those. Any kind of trading software should have that data available
Oh, sure.
to track that already made for you.
Got it. Cool. Yeah, I appreciate the insight. I mean, a lot of these things that we talk about on the show, it's to hopefully enhance your skills or understand how these markets work, how you can participate, but really do that with confidence. So I appreciate you coming on the show here today.
Thanks.
It's always nice having insight of a CMT chart. What is it? A chartered market technician?
Chartered market technician.
Yeah, you had to take a lot of tests for that, didn't you?
Yeah, I did it a long time ago.
Yeah.
I've been a CMT since the '90s, I think.
Yeah, that's awesome. Yeah, just understanding different ways to look at the market, how technical analysis really works. That's pretty cool. So I appreciate you coming on the show. Hopefully we'll do it again.
Great.
And we'll see you soon.
Thanks a lot.
Thanks.